to tell us the webinar is being live.
Hey, YouTube.
Hey, YouTube. Just waiting for you to tell me if you're going to yell at me on my computer or not.
It's a grand day. It's all working.
It's great so far. Yeah, it's working. You ready, big dog?
Let's do it.
Okay, let's go. Welcome, JWB clients, Not Your Average Investor Show community. Anybody in Jacksonville that I know loves to tune in on this stuff because this is by far our most attended show every single quarter. Today, we are talking about the 2026 Jacksonville real estate market outlook. As we finish the year, going into next year, we got some statistics of exactly what real estate is doing. We got some statistics around the Jacksonville market economy, and we got something new this time around. GC, what is it?
Predictions, baby.
Predictions.
You know it.
That's right.
Aim to please.
That's right. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you.
And if you are a regular on the Not Your Average Investor Show community here, you know that we have a little tradition that we normally start these updates with. It's what you see?
The roll call, baby.
Roll call. We got the MVP leading us off.
Mr. Lee Bishop.
The King of the Beach, KOB.
Christopher Lee.
Christopher Lee from Fernandina Beach, the patron Centaurus of the community.
Michael Santorius.
Virginia.
Billy Green.
The Chilly Mountains of Colorado. We got our leadoff hitter batting fourth today.
There you go, John Henning.
John Henning batting fourth. Good to have you. We got Big Pop in the house. We love when he calls us Big
Pop. Pops, how are you, man?
Co-founder of the co-founder, Greg's dad, Mr. J. Cohen. The Ringmaster is in the house.
Drew Barnhill.
The Shaw Man is in the house.
Nadeem Shaw.
Robin Schofield from New Hampshire checking in.
All right, Robin.
Robin. Our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
Sir Jeffrey Bolton.
All right, Jeff.
From Yosemite checking in.
I love that.
The local LinkedIn Lowry.
Ed Lowry.
Ed Lowry, good to have you. Leo Faraganan.
Dun 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 dun.
Faraganan.
Dun 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 dun.
Good to have you, Leo. Linda Evans from the Villages.
All right.
The house. The world famous composer Il Maestro.
John Williams.
Mr. John Williams. All right, we're gonna get this thing started. Normally we go through this whole this whole song and dance here, but we know we got clients on here that don't come to every show. That is just a little tradition we have here when you tune in on Tuesdays and we do our weekly Not Your Average Investor Show. You're welcome to join us, be a part of the community, make some friends, ask some questions. But for right now, we're leaning into the thing that we have been thinking about most, right? As we finish this year, what is 2026 in Jacksonville going to look like? And before we head into that, we've got a big announcement here, GC. What do we got going on?
Well, as we have been talking about on the show now for a few weeks, we are super excited to be hosting our fifth annual. We still haven't figured out. I can't remember. Fourth, fifth, sixth. I don't know. Yeah. Fourth or fifth or sixth annual Not Your Average Investor Summit. And it's going to be held February 19th to February 21st. We are so pumped to have all of you come and join us. This is an event for JWB clients. And so we're excited to meet you. If you're not a JWB client, you have time to become a JWB client. But the announcement today is that we are going to be making pre-sale tickets available next Tuesday live on the Not Your Average Investor Show. So the way it's going to work is we are going to open up sales next Tuesday at 12:30 right here on the Not Your Average Investor Show. You have to have a special code. So on the show next Tuesday, tune in live, be here. We're going to tell you the code, and then you guys can go ahead and secure your spot for those tickets.
Always anticipated, always sells out really, really quickly. That's why the community always asks us to give the date out early. We gave the date out. Now we're selling some pre-sale tickets. And of course, we want to prioritize those of you that come to the show every single week. So be here next week. Going to give out the pre-sale code, and you can secure your ticket before everybody else. And I anticipate it's going to sell out in like less than a week. Usually it sells out in like a week.
Yeah, I think that's what we did last time. I mean, last year we limited it to only 100 folks. I don't know exactly what we're going to limit it to, but it's going to be in JWB's office, the brand new office building.
Downtown HQ.
The brand new one. I literally haven't even seen the space that we are going to be enjoying together at the summit. It'll be that brand new for everybody. So there will be a limit to the number of people that we can have. We're figuring that out. Just show up next Tuesday, book your ticket, come on down, have a party. It's going to be great.
Excited to see who buys the tickets first. All right, that being said, we are going to be talking about numbers today, and this is not coming from financial advisors. This is for informational purposes. This is not any kind of guarantee of future performance. Do your own due diligence. We are here to let you know what the market is doing from the perspective of somebody that manages 6,000 properties in Jacksonville, has been doing it for almost 20 years, owns 400 rental properties. Anything else that I'm missing here?
You did a great job.
All right, sounds good, man. All right. That being said, any accommodation discounts. All right. Well, we're not going to go into a bunch of questions about the event coming up. That being said, Jacksonville market. What's it look like right now? This is a snapshot, right? So we're going to start with the numbers. We know people are coming for the numbers. We want to give you what you came from early, and then we're going to get into predictions a little bit later. So the median single-family home price in Jacksonville right now, currently $349,000. Home price appreciation, 6 months trailing, sits at negative 0.9%. The average JWB turnkey home price right now is $238,000, so a little over 100 grand under that median single family home price. The median days on market right now is 49 days, right? About a month and a half. Months of inventory, the statistic that you made famous here on the show, 5.2. Foreclosure rate at a tiny little 0.6%. GC. What are the numbers here that we most want to look at as we're taking the snapshot of the market?
Well, it's just good to see where we are for pricing overall. So $349,000 as our median home sales price. And we want to understand, are prices going up? Are they going down? Is they staying flat? Interesting here, for those who attended the quarterly market update last quarter, we actually had more of a decline than we have right now. So last quarter, our home prices were down about 2.9% year over year. We talked a lot around that, a lot through that, and how we're working towards normalization with all things in the sales market, and especially pricing. What we're seeing now is a decline of 0.9%. So if it's less of a decline, actually home prices have gone up in the last 3 months since we last met, and will likely end somewhere around down 1% for our year over year numbers, maybe 1-2%. We'll see how it shakes out.
Got it. So if we're like looking at year over year, I see us kind of like looking in this time window. Last time we saw it, it was maybe down here going down. Now it's like slightly up from there. So it's in an upward trajectory, but still down overall.
Exactly.
Okay.
Exactly. And then we included our pricing for our turnkey assets this quarter. I think it's great to show where we love to invest. And we love to invest in workforce housing neighborhoods. So you can see our average investor home is priced at around $240,000, and well below median for the market. Everything else that you're seeing here just reflects this word that we have been talking about for really years, that we have been predicting, been experiencing, which is normalization. This is a very normal real estate market for many people. It doesn't feel that way because we are coming off of an abnormally on fire real estate market. So anything compared to that doesn't feel normal. But if you go back and you look at 2018, 2019, and you saw the days on market, it's right around 49 days. I mean, those were the last what we know to be normal real estate markets, and some perspective really helps here. So very normal for days on market, very normal for months of inventory. I know we'll get into that a little bit more here as we dive into a little bit more of the analysis. But 6 to 7 is actually normal for months of inventory. What's abnormal is foreclosures. They're almost non-existent. Last quarter, it was 1.4% of all transactions were actually REOs or foreclosed properties. Now it's even less than that as I update the numbers. A normal real estate market has about 10% of all sales as foreclosures. So this is so low, and this is one of the big reasons why a crash is not going to happen. In order for there to be a crash, you have to have a lot of homes selling at a very large discount in a short period of time. So foreclosures are almost non-existent, which is great for the health of the market.
Yeah, that's interesting. Like as I see this, I think it's, if you were here for the last market update, this idea of, we went from a more negative curve, like more negative from like 2.9 to like 0.9, this like idea of short-term momentum going up and to the right, I think seems pretty good. But the number that really jumps out of here that we haven't even addressed, right, is this idea that home sales have increased 4% year over year. That feels contradictory to everything you hear in headlines and on the street.
I know. How about that? Yeah, we're talking about the number of home sales, and all you hear is that nothing is selling right now and that things take forever to sell. And this is where some data really, really helps us, along with the perspective. that we have from doing this for 20 years. But yeah, I wanted to pull the numbers for you all to see what total home sales have done in 2025 and comparing that to 2024. So as I mentioned, home sales are up a little over 4% compared to 2024. And I also wanted to go back a little bit more. There's so much insight we can gain from learning from the crazy hot COVID pandemic years, and then going back to 2018 and 2019 as well. So 29,000 sales is where we're at for this year for Jacksonville. If you compare it to the crazy hot years of 2022 is what I put here. We had 33,000 sales at that time. That was the most. I think either 2021 or 2022 was the most that we had for total home sales in Jacksonville. But if we go back to 2018 and 2019, again, we're seeing that our number of home sales is very normal. It's very much similar to 2019. And then there was growth from 2018 to 2019. So normalization. That's the theme of the market right now.
Yeah, and another blip of just kind of like short-term momentum as well, right? Like if it's going up 4%, this idea of like, yeah, cool, we're not where we were in 2022, right? But like we are in the short term, it seems like the market is moving. And like this to me is the stat that just kind of like jumps out because you just hear, I think I sent you something from Instagram saying,
yeah, that was great.
Yeah,
great timing.
It was talking about how like nationally home sales are down and people
inventory's way up and prices are crashing. I mean, that's all we're bombarded with, guys. But the data, the real actual data does not show that for a growth market like Jacksonville. Now, there are some markets out there that are having significant problems. But sometimes the data is just made up in those articles and those Instagram posts. Yeah. Sometimes the data is from a different market and then it is generalized to say every market is that way. Yeah. But this is the strength of having a partner who has their own money invested in this market and manages over $1 billion of real estate. We have access to the real data that is guiding the performance of your assets.
Got it. So you mentioned sales, and we also just mentioned inventory, right? So inventory is down 2% from December 2024 at 10,776 to December 2025 sales inventory of 10,544. At this point, in this regard, inventory down is a good number, right?
Yeah, exactly. Less supply and more demand is what we're showing here over the last two slides. And that what this means to me is we have a very solid footing in the market right now. And the sky is certainly not falling, contrary to what you may be reading out there. And the data really shows it here. So now this doesn't mean that we are positioned for astounding growth and home price appreciation. That actually would not be good for a lot of reasons for our total economy here. But what we're talking about here is a very solid footing in the marketplace. And actually, inventory being down and home sales being up is very noticeable and very if you asked a normal person walking down the streets, they would, if they understood it enough, they would say, no way is that possible. But that's really what we see here in Jacksonville.
So short-term rising of pricing, if we're going from the last market to now, increased sales, decreased inventory, right? Increased, like decreased supply seems like all positive macroeconomic signals here.
Absolutely.
I think the last thing that we talk about when we talk about rental real estate is rents, right?
Yeah.
Let's talk about rents. So Jack's median single family rent price is $1,834. That market-wide rent prices have appreciated an average of 0.7. Is that an average of 0.7%?
Yeah, that's year-over-year price growth for the entire market. Year-over-year
rent price growth has gone up 0.7%. JWB average rent price, as we know, we're in this workforce housing, so it's slightly below the median single-family rent price at $1,501. At homes rented right now, we have 1,359 homes rented year to date. So that is somebody that moved into a JWB home. 1,359 families have moved in year to date. JWB rent collection rate at 98.5%, and JWB early termination / eviction rate is 0.4%.
Yeah. So for the rental market, we want to look at the macro factors. What is the overall rent of the entire, the MSA here in Jacksonville? We want to see, is it growing? Is it not growing? And what we see is that rent prices are growing about a little under 1%. So again, normalization is kind of what we see there. Average rent prices now for the JWB inventory is really important to look at as well, because we manage, over 5,600 homes. So we have our own sort of,
Center of gravity of
flywheel.
pricing.
Yeah, exactly.
Yeah.
It's our own, there's the multiple listing services where we get pricing for the overall marketplace for sales data. It doesn't really work as well for rents. Rents data is a little bit tougher to come by, but we have the luxury of being able to see what our JWB rents doing. And so I always bring that information here as well. So our rents are up. I think it was it was 1490 something last quarter when we were there. Now it's 1501. So things are continuing to inch up on a quarterly basis.
Yep.
We are setting records for the number of homes we're renting. We're setting records for the amount of rent that we're collecting. Early term and evictions are right where they should be from a JWB perspective, and very low and consistent.
Is there no differentiation between an early termination and eviction? Kind of like when you're thinking about this, it's just anybody that is essentially ending their lease early. So okay, like I just had an early termination, but like they basically told me like 3 months ahead of time, right? So very different feeling than an eviction.
True.
As far as like cost to me or like ability to prepare psychologically, but there's no difference here. I mean, we're just at 0.4%,
Exactly,
which is a super low number to begin with.
Yeah, exactly. So all of that would funnel, for this metric, what we're looking at is when does the resident not fulfill the terms of the lease? Because obviously that's not ideal. And so that we want that number to be very low. Now, the ways that they do not fulfill the terms of the lease can vary widely. In your situation, it can be an understood and planned for and a better approach to it. I don't know, unfortunately, sometimes it doesn't happen that way, and then an eviction has to happen. We try to avoid that as much as possible. But either way, such a low rate overall is really what we're looking for.
Okay. And Mystery Man Denny Davis has a question that pertains to this like statistic of 98%. Greg, is JWB's rent collection rate of 98% plus at a record 21 straight months indicative of efforts or changes made in personnel and or process arenas within JWB? Congrats, and a sincere investor fan.
Mystery Man, first of all, thanks for being here. Thanks for that message. I'll pass it along to the team for sure. And then to your question, you want the truth here is that
that's why I brought it up.
The truth here is, as I'm preparing for the show and all the data, there's data that's really easy at my fingertips to get to, and then there's some data that I have to work a little bit harder to go and find. And the data that was really easy at my fingertips is I saw that we had been 98% plus for rent collection over 21 straight months. If I really went and I did all the research, it would probably be double that. So it is just a way of being, is a way of doing things. The standards that our property management team, and really everybody at JWB has a part in this, but our property management team, as far as rent collection, this is the standard, and this is the way things go for JWB, those high rent collections. So to answer your question directly, there's, continuous improvement is what we do. And we lean into the team and training and culture and all those good things. And it creates this environment that we are able to collect a high percentage of rent. And it's been that way for much longer than 21 months.
I feel like that 98 number has been around since COVID times.
I think so too.
I think as like me, as somebody that says it over and over on the show, I'm an auditory number. I feel like 98 plus. I don't know if I remember any time me doing these updates where we were below 98%.
Yeah, I think you're right.
Yeah.
Maybe I'll go back and I'll actually find
Please.
I'll go back and I'll do the work.
Can you do some
work? I'll do the work around here.
All right. So GC, so we basically in the snapshot, in the numbers that we're seeing, again, down year over year on home price appreciation, but up since the last update, right? Up quarter over quarter, right? So like we went from down 2.9% to like now down 0.9%. So the home price appreciation seems like it's going through some good positive short-term momentum. Sales have risen, right? Like home sales have risen,
right?
Year over year,
right? And
so there is increased demand that's happening, and inventory is down, right? So like supply has constrained, and so those are all, and then rents are doing what rents are doing. Rents seem to be doing well, a little bit more than zero, right? Like it's like 0.7% home rent price appreciation. I think the So if you look at it in a snapshot, seems like a healthy market. Seems like it has all positive short-term momentum. But I know that you like to not just look at things in a snapshot. You like to have some data plus some perspective. So let's talk through kind of like how we got here.
Yeah, well, I knew that I was going to is to give you guys our predictions, which is what we're going to do later in the show. And so as I was preparing to give those predictions, I said, well, what was another time that you guys were really asking me what's going to happen for pricing? What was another time that there was a lot of noise out there in the system as far as what pricing was going to do? And so I went back to Q4 of 2022 to go through this case study. We all lived this together, and we had a very different take. We, as not your average investors and JWB leading the charge, we had a very different take on where pricing was going to go. So this isn't our first rodeo making predictions, but this was an important inflection point, I would say, for everybody. And what we were able to do is to really calm the noise. So I wanted to walk you through how we did it back then, and then, of course, it'll inform our methodology for how we're going to do it today.
Just to bring anybody who's new here up to speed, this is a chart that we go to all the time, right? Like this is the historical home price appreciation in Jacksonville, Florida. That's the red line, like the median home price appreciation in the red line. The actual numbers are in this blue line. And as we see here in 2006, we see this like area where
Bubble.
we're way above it, right? It looks like a bubble.
Yeah.
And then we see this like downward fall way below it. And then slowly but surely it's kept up with that line. And then, like you said, when everybody was asking, was Q4 2022, we were well above that line once again. And everybody was thinking, this little circle here, is this circle a bubble? Is this a moment in time? And there were a couple of, like you said, we were like a calming force that we're talking about it, but that's not what everybody was saying. People had very different takes, right?
That's right. So, our thought was that we were going to have what we'll call our own sort of soft landing here. And the theory and what we know to be true is it's all about the trend line. Prices in real estate go back to the trend line for your own market. And we have seen this play out with our own investments and the money that we get to manage for all of our clients now for 20 years. And so we knew that we were going to get back to the trend line. We didn't know exactly when we would get back to the trend line. We thought it would be somewhere between maybe 2025 to 2027. So our thoughts was a smooth re-entry to the trend line. Now, what that actually meant is that we were going to have lower than normal home price appreciation to get to the trend line. We didn't see home prices falling off a cliff. But these were some slides that we put together back in the day. And so these different colored arrows, I forgot to ask you, what are the colors of the arrows? What's the one that says 310 early 2024?
I know how to describe that color. It's like a green gray.
All right, green gray. I was really close with nailing that one.
Maybe.
We said, all right, well, let's lean into the national chatter here. Maybe home prices really do go down. And we said, well, even if they do, this makes sense if you're buying and holding because we know it's going to come back to the trend line. And if it went down a lot, that meant it would come back up a lot to that trend line. And we thought, again, it would be there, call it 2026 on average time frame to be at that trend line. And then we said, yellow, thank you so much. Gosh, we're so in tune, buddy. Well, maybe it wasn't as aggressive as the naysayers. Maybe it was a decline, but it wasn't as aggressive. Same thing would happen. It may go down, and if you believe everybody else, but it would come back up to that trend line. We saw all paths coming back to the trend line because that's how real estate works. It's a consistent asset, and supply and demand and inflation actually work in your favor to get you back to that trend line. Our thoughts were more along the way of the top was
Kiwi green.
Kiwi green. Thank you. I don't know if everybody knows that I am colorblind, by the way. We didn't actually explain that.
This is not a bit.
So, we saw more of a soft landing. And what informed us in those decisions was looking at the key leading indicators like months of inventory. So Vanna, if you would change the next slide for me there. Months of inventory is an important metric because it's that leading indicator, and it looks at how many homes are for sale in inventory on the market at any point in time. And we look at how many homes sold the previous month. So in essence, it's measuring how many months does it take to exhaust the current inventory in the market. And what we know to be true over history is that between 6 to 7 months of inventory is a normal market, and that would lead to normal home price appreciation, which normal home price appreciation over the last 40 years on average is, Pablo?
5%.
Close, 4.8%. Well, tell you, that's good for you. You're always pretty close. Never on time, never exactly.
Say a number. Yeah.
And I'm always positive, so I'm always going to say you're pretty close.
Yeah.
So the average home price appreciation for the Jacksonville market is 4.8% per year. Yeah. So if you're between 6 to 7 months of inventory this is only in a vacuum, you would likely be looking towards, 4.8% home price appreciation or something like that. Well, when we were asked to give our thoughts for where we saw the market going, and we always have the responsibility to help our clients manage their money well, we looked at this MOI and we saw 3.7 and we said, you know what? We know higher interest rates are coming. We don't know how long they're going to stay, but 3.7 months of inventory is incredibly low. And in our minds, and because of our data and experience here and our perspective, we knew that what that does is it creates a high floor. And that informed our predictions, our thoughts on why we saw a soft landing.
Yeah, why you didn't think that it was going to be that sharp downward curve like we saw back in 2006.
That's right. We've been doing this for 20 years. We actually were a part of 2006 and 2007. We had our money in it. And we saw what happened with months of inventory on the other perspective. So just like we said here in 2006, when it was really a bubble, we had home prices at $226,000 at that point, and inventory was at 5.7 months of inventory. So at that point, nobody was looking at this and saying, you know what, there's a major problem on our hands. But over the next year, what we saw is that home prices came down a little bit. But the real thing that we saw is that MOI doubled. MOI went way high in a short period of time. And that was the indicator that there was going to be pain and serious price declines in the Jacksonville real estate market, as well as, across the country. That is what we know to be the great financial crisis.
Got it. So that's the opposite of like not the opposite, but that was the main variable that you were seeing in the difference, right? Like these other leading indicators were happening that the media and people were like freaking out about, but you knew that there was some kind of floor there because in 2006, this MOI number went out of whack. Right now, the MOI number at the end of 2022 was super good. So like you could take some pain, which we endured that pain.
We did.
We did the higher than average interest rates, and this is what we saw.
What do you know?
Like this is like what Sir Jeffrey Bolton said here in the chat when he was looking at those numbers. Says it looks like a regression to the mean, which is exactly what you predicted. You predicted that Kiwi green line, where you would come back to this mean line as opposed to like going way down below it and then coming back and having to recover.
Exactly. That's exactly right. This regression to the mean is such a core concept of why this asset is so awesome. We can call it regression to the mean. We can say it follows the trend line. Your home prices are going to get back to that trend line. And most of the time we actually hug the trend line. And when we say hug the trend line, that means reduced variability. That means peace of mind. Some of the things you don't get in other asset classes. And then what we also need to realize is that when you hug the trend line, when your prices go along that trend line, what you're getting is your money is growing at about 10 to 12% a year. And so it's doing it consistently. So regression to the mean, coming back to the trend line, this is what prices do. This is one of the reasons why we love this asset class so much, because that trend line is a factor of supply, demand, how critical of a need this asset class is, inflation, all those things really kind of give you these bumper lanes for the most part of what your returns are going to be, assuming you buy and hold. And, that's what we've seen here. We were right. We were right because of the data, because of the perspective of seeing the market play out in different ways over the last 20 years. And that right there has allowed you all to make really good decisions and continue to add to your portfolio and not be worried about the next crash.
Yeah. So this is kind of like where, for me, as you're presenting this to me, it's kind of like all the things I've learned on the Not Your Average Investor show coming together, right? Because this is, again, we're saying that this trend line means that we're getting 10 to 12% returns. At the end of the day, this is 4.9%, but that means that when you are combining leverage,
Yes.
you're combining so smart debt, right?
Yes.
Where you're combining the cash flow that comes into it, the tax savings that comes into it, the principal pay down, all those things provide high floors and hedging against inflation. The idea that these real estate prices keep up with inflation because of replacement costs and these
Yes.
kinds of things. And it's not as easy to like go fire sale whatever I had because real estate is a slower moving thing. You can't just push a button on an app and like move off of it and go buy something else,
Yeah.
right? Like it's like this like long-term kind of like stable feeling of prosperity that happens over time. And as long as you stay in it, you have this really nice return that is higher than you're used to getting for something so safe,
Yeah.
right? Like this, like 10 to 12% over time, even during the hardest times with like the biggest kind of like headwinds possible, we still find ourselves here on this trend line.
That's right. And this trend line should give you comfort. The returns obviously are what attract us to this asset class, but it's the peace of mind. It's the fact that you can have consistency. I think what we'll see, over the next 5 years, 10 years, there's going to be a lot less variation to the trend line than even we saw for the last 10 years. I mean, it was sort of an anomaly that we were so far below the trend line. What you're going to see is we're going to hug the trend line.
Yeah.
Right? That's the way it's looking. Obviously, you can never tell if there's going to be a pandemic or whatever, but what we're seeing is this is the way that real estate typically works. And there's so much benefit to build your financial outcome based on an asset that hugs the trend line and reduces that variability. And that's why we love it.
I mean, it makes sense just looking at this thing and saying, okay, so there was this like giant black swan event, this like systemic crisis inside of real estate, unlike ever before, that created this, weird relationship with the trend line when it went way down, and then a much more normal kind of like pandemic once in a like
Right.
that's a black swan too, but it's also not something that was caused by real estate abnormality,
Right.
which is what most financial things are, right? Like not necessarily caused by real estate. It's just caused by externalities and doubt in the market and all these other things and all these other asset classes going wild and maybe the government printing a bunch of money and doing all these different kinds of things. But real estate over time keeps track. And now here we are in a very stable environment with short-term indicators looking up and right on this trend line looking ahead. Right?
There you go.
Cool. So that is the real estate outlook, right? This is why we all love real estate. This is why, I've decided that I like thinking of my majority of my wealth being in this kind of like high upside, high floor kind of asset class. But this is the Jacksonville market update, right? So let's talk about actual Jacksonville, independent of real estate.
Yeah, absolutely. I wanted to just share with you guys why I love this market so much and why many of you love this market so much. Some data. We'll add some other just great things you might not know. So we're going to include this as a part of the ongoing market updates as well. At the end of the day, when you're thinking about how you want your money to grow, you want to make sure that you have your money in a place where population is growing. And that median income is growing, because when population and median income are growing, that means that you have a better chance of home price appreciation to happen. So that's the growth component. But you got to make sure that this isn't speculative. You got to make sure that this provides that monthly income stream for you, so it keeps you in the game, and so you can add 1, 3, 5, 10, however many properties you need into your portfolio. And that's where a low sales price comes into play. And there are some other factors beyond this, but if you can just zero in on the right market for you and it has low sales price, that gives you a good chance of cash flow. High population growth and high median income growth means that you're going to set yourself up for a bigger profit pie overall. And so Jacksonville, wins in these categories. Jacksonville is actually the only growth market out there in the U.S. currently that is priced under $375,000. You know how much I love the word "only" as a marketer in my former life.
Right? You know how much I love the word "only."
I know, right? It's why I capitalized it. Yeah. Right. But really, we are the only market out there. And look at some of this population growth numbers. And these are trailing indicators too. We've had 21% population growth, and you compare that to the US average over the last 10 years, we've only had about 5.5% population growth. So a lot of people are moving from different parts within this country to Florida, to Jacksonville.
From the Northeast, from South Florida, from the West Coast, right? Like people are moving to Jacksonville. That is definitely something you feel when you live here as well. And then the median income growth as well, right? Like higher than the US average, something that we've been feeling, right? Like I think anecdotally, I've been feeling this since I moved here from Miami as well.
Yep.
I just went back to Miami for um, Thanksgiving,
Yeah.
right? And it was really interesting because we hired one of Marta's old architect buddies that she used to work with to take pictures of us and our new puppy, Miss Piggy,
Nice.
in our old neighborhood and whatnot. And she was talking about her like career trajectory and like what she's making these days.
Yeah.
And it wasn't close to like kind of like the income growth that the person in Miami had felt.
Yeah.
Right. Like it was it's pretty eye-opening, just like the opportunity that's here and the median income that's happening here and like the things that we see in the job market here as well, right? So like this idea of, I mean, I love a good deal. Like I love a good low price, right? Obviously, it allows for more people to enter the market. I think what you've taught me is it's price to rent ratio is really, really important.
Mm-hmm.
So having a low price gives you a really good shot at a good price to rent ratio.
Right.
And then having population growth and median income growth that continues to support these rents
Mm-hmm.
that continue to make that price to rent ratio really, really good is the thing that we continue to yell from the rooftops about Jacksonville on top of quality of life and all these things with population growth. But what really sticks out to me is all the news that Jacksonville is making as far as not lagging indicators, but future indicators, right? This idea that it got ranked #1 for young entrepreneurs in Forbes magazine, #3 in top large cities for U.S. cities for economic growth, in co-working cafe, the bastion of intelligence that we all know it is. The #4 best large city to start a business in 2025, 7th best big U.S. city to live in, 10 most moved to city in 2025, 21 in most renter friendly city, #2 on best downtown for pandemic recovery, and top ranked city, Florida City for population growth this year. I mean, all these headlines that continue to come in to me are just this like increasing data point of a thriving job market that attracts people, that is a great place to live, and inevitably will make, whether people are buying homes or renting homes, the price is going to continue to go up.
Yep. Well, and guys, I think the choice for the right market today and over the next 5 years it's always important, but it is so much more important to choose the right market to put your wealth into in rental properties over today and the next 5 years. So much more important than the last 5 years.
Interesting. Say more.
Well, over the last 5 years, really anybody who owned real estate, rental properties was going to walk away a winner. Right? Because you walked into an environment where there were super low interest rates and, you had super high home price appreciation.
And a bunch of cash flow pumped into the system.
And there were a lot of people who just bought rental properties because, the media said, hey, this is the right thing to do. And they didn't really know it, but they walked in and they were winners, which is great. It reminded me of the time from 2001 to 2006. Right? Yeah, so like, everybody was a winner 2001 to 2006 who bought that real estate if you bought it early enough. And it didn't mean that you were good, didn't mean that you were savvy, didn't mean you knew the fundamentals and what to look for. You just lucked out. Well, over the next 5 years, you're really going to separate those investors who are savvy, who really understand the right market to put your money into, because the profit pie that we talk about so much more, or the profit pie that we talk about so much, is going to be so much more in markets that have significant population growth and have significant median income growth. And, if you can find some that are still low price today, well, now you have this great recipe for growth. And ultimately, we in this community just think in terms of financial outcomes. Yeah. We all have a financial goal or an outcome that we're working towards. The opportunity to choose the right market and to look beyond just what is, down the road from you or in your neighborhood, and choose the market to put your assets into is going to be a great separator.
I know from our conversations that there's assumptions behind what you're saying right now that aren't immediately obvious to our friends that are listening right now, right? Like when you're saying choose the right market, I know that you're talking about, You've been talking to affiliates. I've been out there in the market. Like I just got back from a rental investing mastermind, and everybody's falling in love with these other markets. Like I just got back from that one in Vegas. People were just like, Detroit, man, it's super cheap. Like, look at these like brick houses that you can buy that were built by like Frank Lloyd Wright. Like,
Yeah.
and yet you think that that's not a great idea, right? Like, tell me why. Tell me why Detroit isn't the place that everybody's going to be able to like do well in.
What's the temperature right now in Detroit?
No,
I don't know.
cold for me today.
We ran this morning, and you should have seen Pablo dressed up this morning running. By the way, he had like tassel caps on tassel caps. I mean, he couldn't handle it. It was 49 degrees, I think, here. And I just bring up a point. It's not rocket science where population is growing.
Yeah.
People have the ability to live in a place with better weather now. They are less tethered to their jobs now. Quality of life, low state income taxes or no state income taxes, having a beach, the weather, these things do not change. And now people have the ability to have more of what they want from those things.
It's interesting when you say people have a choice to live where they want to live, right? Because we talk a lot about kind of like how important the job market is as well.
Right.
And so I think it's important to say, when you say weather, that is hey, yes, everybody got untethered. There's a big part of the population that's untethered from like where they need to live to where they need to work, right?
Mm-hmm.
Those people are going to look around and they're going to say, do I want to live in super cold weather? Do I want to live somewhere with low state income tax, right?
Yeah.
Like, do I want to live close to a beach? They're going to say yes.
Right.
Right. And then there's also the people that just need jobs. They need to move to where the jobs are.
Right.
And they're going to move to places where
Jobs
there's a
growing.
lot of jobs.
Yeah.
Right. So like when I look at Detroit, I'm like, are we betting on the auto manufacturing companies coming back? Like there's all these different places in like cold weather climates with old manufacturing infrastructure that people are saying, oh, well, maybe there's like the battery belt or whatever, right? Like what the Rust Belt used to be.
Yeah.
But any one of those places, like I just haven't heard a convincing argument for which one of those places and why are all of a sudden going to be the ones that like come back to life. Whereas like in Jacksonville, I see a city that is not coming back to life, a city that's just like blossoming in life, and all these jobs and all these different things that are happening. That is also below the U.S. median income as well.
Exactly right. Exactly right. I mean, you can look back over the last 10 years or longer for population growth and see which cities are winning, which cities are growing, and which ones are not. For Jacksonville, we just looked at the stat and we have 21% population growth over the last 10 years.
Yeah.
The median or the average for the US is 5.5%. Well, which cities are those folks leaving from so that 21% is growing in Jacksonville?
Probably the ones that have 3% population growth.
Yeah, exactly. And I don't know right off the top of my head what Detroit's is, but I guarantee it's not 21%.
Yeah.
I happen to know Cleveland's because I beat up on Cleveland a lot because I'm a Pittsburgh Steelers fan. And, Cleveland population has declined recently. So, the most important thing for you to make more money in rental property investing, number one, be with the right team. But number two is the market. And the biggest component of the market that's going to grow your profit pie is home price appreciation. And the biggest indicator of home price appreciation is where are people moving? Yeah. What is your population doing? So when we look at a place like Detroit, I think Detroit's done a nice job of changing the perspective or the way that people view Detroit. I think and I haven't been to Detroit recently, but I
went semi-recently. The downtown's awesome.
I think they've reshaped the
cool.
name of downtown and what people think and feel there. But the reality is that the population is not growing in Detroit like it is in Jacksonville. And population is not growing in Cleveland like it is in Jacksonville or Indianapolis or some of these other cities. So you want to go where the tide is rising. And what people fail to understand is that rising tide of home price appreciation and that population growth is the single biggest driver of your profit pie.
Yeah.
And you already have the answers to the test unless you think people are going to like living in the cold more than the beach.
Yeah. And something I haven't really discussed with you was a huge aha moment for me at that real estate investor mastermind, because somebody was from the Detroit area and they were complaining about the contractor base because of the exodus in people over the recent, amount of time. There was just like a dearth in, well-established contractors to maintain properties.
Yeah.
Right. So like if we're talking about the jobs that tether people, right? Like if you're going to start an HVAC company from scratch or whatever you're going to do, right? Like you're going to want to do that in these like cities that are growing.
Yeah.
Right. Like
100%.
that is what de-risks it. So
Right.
like I feel like the whole population growth and median income numbers and all these things also spur the service businesses that as rental property investors, we count on to support our rental property investment as well. Because people, we need people. Those are sure they're not going to the AI route, right? Like
100%.
yeah, totally. Okay, so I think it's time for predictions. Do you see?
Let's do it.
I'm gonna do a little recap, right? So short-term momentum as far as the real estate numbers. We have a short-term rise in home price appreciation. We're from last quarter to now. Overall for the year, it's still at negative 0.9%. Sales have gone up year over year. Inventory has come down, and those are the numbers that we saw. We are now back hugging that trend line, right? We have flattened out. We're right at that trend line perspective of like that chart that you just showed us. And of course, Jacksonville as a local economy is gangbusters, right?
Strong and growing.
Yeah, strong and growing. So what are your predictions going forward here?
Well, we used a lot of sources for our predictions. We use the consulting that we pay a pretty penny for. John Burns and his team do a great job giving their predictions. We look beyond that. We look for our own data perspective, our own experience here. And every year when my business partners and I sit down, typically in October, we map out the year for the next year. And at the core part of it, one of the first things we do is we say, what do we think the market's going to do? So wanted to share all of that information exactly with you guys. We just shared this with the team as well. And the first thing that we think is going to happen is the biggest question is interest rates. We have all learned how much the real estate market, both rents and prices, are dependent on interest rates. So we see a little bit of interest rate relief. We see maybe about a 0.5 point drop. Right now we're at about 6.2, 6.3% for the average interest rate for a 30-year fixed rate mortgage. We think we're going to be somewhere between maybe the high fives and kind of where we are right now. I also put here the historical average because I think that is important to have some of that perspective as well. The historical average for 30-year fixed rate mortgages, according to Freddie Mac, is 7.7%. So again, higher than what we all want because we're coming off of the heels of 3 and 4% mortgages. But if you look at it, 7.7 is actually the historical average for the 30-year fixed rate. And I can share my personal experience here is the very first properties that I was buying with mortgages back in 2006 and 2007, they had 7.5%, 8% interest rates on those mortgages. And I thought that was awesome back in the day. So that's kind of what we see from the interest rate perspective.
So interest rates, you expect about a 0.5% drop. Okay.
Over the course of the next year.
Okay. Single family home prices?
Yeah. So from the home prices perspective, because we are going to get a little bit of interest rate relief, but not a whole lot, we don't see happening. We think we're going to have slightly positive home price appreciation in 2026. We think maybe a max of about maybe 3% home price appreciation. Again, a lot of this when it comes to predictions is very dependent on interest rates. Everything could change in the world, as we have seen everything change from time to time over the last 5 years. If interest rates would go dramatically down, we could see home prices going up a lot more than that. But we think it's going to be somewhere, call it 0 to 3%, actually slightly positive to 3%. And the historical average for Jacksonville is, again, that 4.8% home price appreciation per year.
Okay. So you see, this is year over year, you see it going positive next year.
We do. Yeah.
Okay, cool.
We do.
All right.
Yep. Months of inventory, again, is a leading indicator. And historically, you're between 6 to 7 months of inventory. We see it staying between 4 to 6 months of inventory. Right now, it's a little over 5, and that's very normal for this time of the year. The seasonality comes into play here. So we think we'll be somewhere between 4 to 6 as we go into 2026.
So MOI staying relatively similar to like what it looks like right now. Do you think it's at what point do we like have a new normal of like MOI? Like I feel like this like 4 to 6 months of inventory seems more realistic over the long run for Jacksonville than like the 6 to 7 from before. But I'm just saying that, right? Like,
well, it's interesting. I think your point's really valid. The way you get to your point, let me help you a little bit though. So, 4 to 6 is kind of where you have seen for the last 5 years that you've been
I guess
investing.
it's like, yeah.
And you're like, well, this is pretty much staying the same. Does it ever change? I mean, we've just had really low inventory for the vast majority of the last, 4 to 6, last 5 years you've been investing. So the fact that it's been 4 to 6 and here doesn't mean that it needs to change. It's just, it is what it is. But we are actively looking into what is the new normal for months of inventory because a lot of things have changed. Technology, the access to information has really changed. And the whole process of being able to buy a home, build a home, and buy a home and make decisions is a lot quicker for people now.
Yeah.
And so, if you're able to systematically speed up the decision making and building and selling and making decisions process, then it would stand to reason that 6 to 7 might be lower. It might be lower than 6 to 7 would be the, historical average. I think we're kind of exploring that. John Burns has brought that up. I think it remains to be seen. We're certainly open to that idea.
Yep.
I don't know if it's going to be 4 to 6. I don't know if it's going to be 6 to 7. I would say somewhere around 4 to 6 feels right, but I think we need more data. And so that's kind of where we're at right now.
And then single family rent prices here?
Yeah, so we see those going up slightly as well. So kind of the same story as pricing. We think rents will be up and slightly positive. We think we'll be up maybe a max of 3%. And historical average for Jacksonville is 4% a year.
As I look at your predictions, GC, I can't say I'm surprised based on the stats that we just saw, right? Like everything seems slightly positive, trending slightly positive.
Would you call this, boring, maybe?
Yeah,
I nailed it.
Yeah.
I'm true to myself.
Yeah, slightly positive, pretty good, about average, no big surprises is kind of what I'm hearing from you. Is that what you're trying to tell people?
Yeah. And more than that, like we need to get back into this zone of expecting boring from rental property investing and loving boring. Like I love boring. It's just kind of how I'm built anyways, but I really love rental properties because I'm looking for something boring that provides a high floor, consistency, and high returns so that I can accomplish my financial outcome. So this concept of normalization or, relatively boring performance is how rental properties have performed most of the time. And we don't need a huge reason that this, you need to go out and buy rental properties because of this, that, and the other thing. You buy rental properties because they can perform. It's a critical need. It's consistent and they're boring. They just work. You can go and do, what you want to do and not have to stay up late nights or watch the ticker or whatnot. It's just working for you in the background. So that's a theme that I think we're going to see in 2026. And I think that we're going to see more and more of that theme as we look a little bit farther out from 2026.
Definitely something that I like about rental property investing, right? Like never before until I grew a rental property portfolio do I feel like I have this like thing that I know that I'm banking on for later on that I know isn't going to go anywhere. It's kind of like continues to self-feed itself because it's got the cash flow that continues to allow me to reinvest into it and all these different things. I think I got into it during a very exciting period, right? Like I was just like I heard everybody on the show saying right now is the time. But as I continue to mature as an investor, for me, I'm just like, yeah, this just feels like the thing that I want to continue to build an army of cash flow properties that continue to like give me better and better options as this thing matures. So the idea that we're getting back to normal feels like for me, who got in during like a very abnormal period, it's still getting back to way better than I was before I got into the asset class.
Yep.
Which I'm really, really pumped about, man. So it's pretty cool that it's like right on the trend line, right back in your wheelhouse of like
I know. I'm really excited about this messaging that we can continue to go forward with. Because deep in my heart, even when interest rates were what they were, we talked about it. I was like, listen, you're going to see higher home price appreciation, but I'm always thinking about buying and holding for 10 years or 20 years because that's what most of our clients' goals dictate. And even when there were low interest rates and high appreciation, what did I say? I said, listen, it's going to come back to the norm.
Yeah.
It's going to come back to the norm.
Yeah.
Well, that's what we've seen happen.
Yeah.
And so there's beauty in the norm. There's the trend line is beautiful. Let's hug that trend line. Let's get excited about hugging the trend line. That's probably what we're going to be doing here.
And if you want to hug that trend line, you want to invest in the most boring asset class that's going to be there for you, provide a consistent experience, help you grow wealth over time, and lead to a better retirement. You can call JWB at 904-677-6777. You can text them at 904-293-0341. You can schedule an appointment at chatwithjwb.com. Easy peasy. They make it real boring for you. And let's get into some Q&A here, GC.
Let's do it.
All right. We got Mike Foster asking total Jacksonville home sales each year compared to adult population those same years would be an interesting metric if even available. Total Jacksonville home sales each year compared to adult population those years. So like not just growth, not trends in growth, but what is the population and what is the total sales?
Okay.
What do you think about that as a stat?
Where I was going was looking at what the total population growth was compared to the growth of the home sales.
Mm-hmm.
I think that'll probably be a better, because I think what Mike's looking at is like how much should sales be compared to like 2019, knowing that the population has grown and that, you know, people need homes to live in.
Yeah.
So I can pull that. I think that would probably be a good sign or a good thing to look at.
Okay, let's take a look at it. Leo Faraganan has a question here. What is the average days the rental property stays vacant in Jacksonville and with JWB? What is the vacancy rate in Jacksonville and JWB right now?
Average days the rental property stays vacant in Jacksonville. That's a really hard metric to get to. There's not really a database to share that. For JWB right now, it's about 60 days on average to be able to rent the home. That means that, you know, it takes 30 to 45 days to rent the home and then roughly 15 days for somebody to move in. The average vacancy rate in Jacksonville, that one's, we might have a metric on that from John Burns. I'm not sure. I can look into that for you. But JWB's, our metric is 96% plus for vacancy. I would guess it's like 93 to 95% for the overall marketplace for Jacksonville single family rentals. But I'll see if I can get a good stat for you there.
Good stat. Sir Jeffrey Bolton says, do you think the lock-in effect, fixed debt with 3% range, will cause lower new normal with lower inventory? Like, do you think this, like, people locked into like low debt is going to create a new normal with like lower inventory?
Well, I think the lock-in effect is real. That's one of the reasons that we have seen such low inventory for so many years. Yeah. But I think that the lock-in effect is not nearly as powerful today as it was back in the day, because interest rates are coming down, which lessens the lock-in effect, and just the amount of time. You know, listen, people weren't going to refinance a house that they had, or they weren't going to sell a house that they had a 3% mortgage on, you know, 6 months later. But if it's 6 years later, you know, they might just say, hey, listen, I like the low mortgage, but interest rates right now are 5% and my family needs it. And I've enjoyed it for 6 years, so I might be more willing to sell my house. So time and what interest rates are doing right now is, the lock-in effect is still a powerful thing, but it's lessening the impact of it. To get to your question directly, is that going to cause a new normal? No, I think the things that could potentially be causing a new normal are more things like technology, the ability to be able to make better decisions and have access to information. I mean, most people have a pretty good idea of what their home value is because of sites like Zillow today. And if you go back 20 years ago, I mean, nobody had any clue what their home was worth. So, you know, people have more access to information, better technology. Building is, you know, decreasing the cost of builds should happen as technology comes, and just the ability to sell is better and easier because of technology. So I think those things could dramatically shift what months of inventory is, but I don't think it'll be the lock-in effect.
Okay, sounds good. Anonymous attendee asks, Greg, how do you see demographic and immigration trends impacting the Jacksonville market over a full market cycle?
How do we see the demographic and immigration trends impacting the Jacksonville market over a full market cycle? Well, I think people have shown that they want to move to Jacksonville. And so again, population growth is the largest indicator for future home price appreciation. So I think that we're going to benefit a lot because of those demographic and in-migration patterns that are moving within the country, moving to Jacksonville.
I would also assume that when it comes to immigration, like I don't know how you make a distinction between kind of there's the buoyant force of immigration from like within the country, and then whatever immigration happens, they're going to go to places where there's opportunity and low prices.
Sure. Yeah.
Right. So
Yeah.
like
we don't lead the way as far as folks coming from other countries coming to Jacksonville. And if they come to the state of Florida, then many times they go to Miami.
Yeah.
But we're not that far from Miami, and we're a lot less expensive. So you'd think that we'd benefit from that too.
Yeah. Lee Bishop, the MVP, says, will these slides be available for folks on the podcast?
Lee, just we'll make it available for you. Just email your portfolio manager. We'll make sure you get it in your hands.
Sounds good. Another anonymous attendee asks, what percentage less than market value would I expect to be able to sell my rental property?
I need a little bit more context here. How quickly are you looking to sell it? Are you looking to sell it to just an investor, just who typically would require a discount? Or are you looking to sell it to a retail homeowner? What I would recommend is that we plan ahead. If it's the right thing for you to sell your asset, get it to a place where you can sell it on the open market to somebody who wants to live in the home. That's the way to sell it at market value. So I don't think you necessarily need to sell at a discount with proper planning. And if you're a JWB client, we can certainly help you prepare to be able to maximize your income as you liquidate.
As is what they were saying. They want to sell it as is.
Tough for me to just, give you an answer there. If it's as is, that means that there's probably some repairs that are required to do it. So it would be dependent on that. I would just encourage you to if you're not a JWB client, talk to a professional and plan it out. The last thing you want to do is just put it on the market as is with a short timeline. I mean, that's really where you might have to take a discount in order to move it.
Yep. Lee Bishop, the MVP, says, Greg, do you think the fact that JWB has 2- and 3-year leases artificially reduces the rent prices on JWB homes?
Great question, Lee. I feel like Lee sometimes gives us softballs, so I'm glad that he's bringing which I super appreciate the softballs too, but I also appreciate this one too. Do we think that it would artificially decrease the rent? The answer would be no. When we sign 2- and 3-year leases, so much benefit for it, but we have to make sure that there's a benefit to the investor and to the resident. Now, the fact that I feel confident that it's not artificially decreasing the rents is because no matter if you sign a 2-year lease or a 3-year lease, from year 1 to year 2 for a JWB lease, there is a built-in rent increase. Depending on the property, it's generally between 4 to 6% of a rent increase from year 1 to year 2. And then now there's an incentive for a tenant, to sign a 3-year lease, which we keep the rent from year 2 to year 3 flat. But then when we go to renew, no matter what, when you renew, you go back up to market rent. So the max amount that we would be forfeiting as far as rental growth would be 1 year, and then we get right back up to market. And that's a great trade for you to make as an investor, because if you're keeping somebody in your home, you're reducing maintenance costs, reducing vacancy costs, all that stuff. So long story short, it's very thoughtful to make sure that we are, seeing rent growth through our leases, which we do. We have them built into every single lease. We are creating an incentive for the resident to be able to sign up for a longer term lease, but we have a cap on that in essence, because we do bring it back up to market rent when they renew. And all of this is fully explained to the resident when they sign the first lease, through the leasing process, at the renewal. So everybody understands that market rent is really where you're expected to be.
Awesome. We're a little bit over time. I think let's knock out 2 more.
Okay.
Then we can get out of here. All right. My buddy, Bob Wiesner, is asking, any forecast for other costs involved with real estate investing, such as real estate taxes, insurance, and maintenance costs?
Absolutely. We expect your operating costs to go up 3% a year. So that would be things like property taxes, insurance, maintenance costs, all of those things. And that's built into every JWB pro forma.
Insurance feels like prediction is low to flat to go down.
Yeah. So, I mean, if you've been watching the show recently, we talked about how Florida actually had the lowest increase year over year for insurance costs of any state in the country. And we do think that there is a chance. I'm not going to predict that it's going to happen, but we have seen some rate decreases. So now, with that being said, I would still prepare in your pro formas to expect a 3% cost increase across your operating expenses, taxes, insurance, maintenance costs, things of that nature, just because that's just sound. And while you might win in one thing, you might get a lower increase on your insurance. You never know. You might get a higher increase somewhere else.
All right, last question. Bob says, late question. In what way can JWB help prepare a client property to sell? He's not looking to sell. He's just curious.
Yeah, we're a resource for you throughout your entire ownership journey. So how can we help? Well, number one, we can help you decide if it's the right move to sell. If we need to get money into your bank account, there's a number of ways that we might be able to do that. Selling might be one of them, but there's a ton of other opportunities for you to be able to do that. Refinancing is the first thing we might look at because there's so much value to holding onto the asset. And refinancing is that income coming into you tax-free. There might be other things that we might be able to help you do. So first, just to understand, is it the right idea to sell? Talk through that with you. At some points, it is the right move for a client to sell. And it's pretty rare, but that is true. Maybe you held on to the homes for 20 years and it's the right time to sell. Well, we're going to be able to do that process with you and actually facilitate that with you. We have JWB Realty in office here. And so we're going to be able to literally connect you with another teammate here at JWB who can now list your home. And we're going to make sure that your home is ready for maximizing the revenue that'll come from it, to kind of piggyback on the earlier question, so that you don't have to sell at a discount when it is time for you to sell. So all of that is a part of the vertically integrated process that we have here at JWB. So that's there for you.
All right, GC, we're going to wrap it up here. Just want to remind everybody, Not Your Average Investor Summit coming up. We're announcing tickets going on sale next week, so join us live. And you're going to get a pre-sale code that you can buy your tickets early. It always sells out quickly. So be on the show next week. Next week, we're talking about something that people have been talking. Oh, which, by the way, reminds me, next week, join the Not Your Average Investor show weekly. We do this every single Tuesday, right? So every Tuesday, 12:30, if you're new to this report because you're a new JWB client, you like this idea of discussing real estate investing with a bunch of intelligent people that ask really, really good questions, join us Tuesdays at 12:30. Next week, we are talking about something that I think people have talked about a lot, but they're not talking about it from the investor's standpoint, and that is the 50-year mortgage. We keep getting all these different articles being sent by the community asking us to make an opinion on it. We thought the horse was beaten to death, but it turns out most folks are just talking about it from a different perspective, not actually giving good advice. I'm seeing claps coming in, so I see that people want to talk about it. The 50-year mortgage, these portable mortgages that are coming out, these differences in mortgages. We're going to do a Not Your Average Insights edition. Greg and I were prepping for it a couple days ago. I think it's going to be super interesting. Would love to see you there. And from now till then,